Welcome to our fourth quarter update for residential, kind of end of the year recap as well. I'm Dave Codre, and I'm excited today to talk a little bit about the difference between apartments and mobile homes and the trends that we are currently seeing. So let's dive in first with the residential apartments. In the fourth quarter, we saw revenue gains that hit about 4% for the quarter. We're up 12.5% for the year. During that time frame, we had 97% occupancy, so everything's well occupied. We did see an increase in our economic vacancy, though. So the difference between economic vacancy and actual vacancy is really the number of days that are vacant. So if you run an occupancy report at the end of the quarter and it shows 97%, that's just showing you that point in time, what it looks like. Economic vacancy takes into account essentially how many days were vacant during that whole quarter. So we had just over 5% economic vacancy in the fourth quarter, up from about 4.5% in the third quarter. Most of what that stems from is we are starting to do some pretty big value add unit turns. We're seeing 20, 30, 40% rental rate gains on deals that we have. So we're taking really cash flow that we have, reinvesting it into some hefty unit turns, able to see some significant rental rate gains. That is also driving up that economic vacancy number that I just mentioned. So I want to compare kind of how our operating margins on the apartment stuff is working versus the mobile homes. We're seeing some really interesting trends. So we look at our revenue growth and we look at over a 2-year period. So if we back it out larger than just one quarter over the previous quarter, if we look at 2 years, so we've had 25% revenue gains across the board on our apartments. Now during that time frame though, we've seen almost 49% growth in our materials costs. We've seen 33% growth in things like drywall, hardware, lighting fixture, doorknobs. We spent 33% more dollars in 2022 than we did in 2020 on the same properties, the same kind of turnover, the same general plan. Our landscaping costs were up 16% during that time frame as well. Now, on the apartment side, we look at those as our controllable costs. Our controllable operating margin, which means for every dollar we collect, how much do we keep, was 57%. So we kept 57%, and our controllable operating margin actually increased from 2022 when it was down around 53%. So our revenue increased enough to cover these pretty substantial costs that we have seen. Now we take that down and we bring in taxes and insurance and the like. Our taxes and insurance went up about 25% in that same time frame, but our NOI, the amount, our net operating income, our margin was still 39%, up from 37% 2 years ago. So apartments as a whole have made enough revenue gains to keep and expand their operating margins. That's why apartments have performed so well over the past 2 years. We see a different story when we look at our mobile homes. Now, this past quarter, we sold 2 more of our mobile home parks, and we have been selling a good number of these over the year, especially since 2020. We've probably sold about 1,500 mobile homes since that time frame. Now, for the fourth quarter in mobile homes, we actually saw a revenue decline. We were down about 0.5%. So nothing drastic, but we saw about a 0.5% revenue decline since the third quarter. Overall for the year, we're up 3%, and on a 2-year period, we're up just over 17%. So not the 25% gains that we saw in apartments, but we're up 17%. Now here's where there's a different story. The material costs on the mobile homes have been significantly different. Our repair costs are up 24%. They were only 49% on the apartment side. Our interior items, remember we're talking about hardware, drywall, light fixtures, that stuff's up 188% on the mobile home side. Landscaping is up 25%, and wages are up over 50%. So mobile homes inherently are a much harder asset class to operate. So while you look at, some people are looking at those and seeing, those can be a cash cow, but on the other hand, they're very challenging to operate. So our revenue on our mobile homes has not outpaced what our expenses are. So a controllable operating margin on our mobile homes decreased to around 51%. And it was 58% in 2020. Our NOI, remember that's the net amount that we keep, was around 40%, and that's down from 48% in 2020. So now we have a point where our mobile home net operating income is about 40% margin, and our apartments are coming in around 39% margin. So they're becoming pretty close, but mobile homes are much more difficult to operate. Now, both of these are net operating income margins. So below that, you still have your debt and you still have capital improvement. So those could vary widely based on how someone owns a deal. So we're taking that out for a comparison standpoint. However, all of our debt is fixed, so we have a pretty consistent number. We know what it's going to be each year. So overall, we're seeing is this trend is showing that mobile home performance is kind of maybe top-lined, right? And it's kind of hit that apex point up there. And the other part on apartments, they've still shown that they're seeing some margin growth. So what do all these numbers mean? We've seen a ton of revenue growth over the years, and now it might look like revenue growth is not guaranteed. It's like we're starting to see a little bit of headwinds on revenue growth, especially on the mobile home side, where it was kind of flat for that quarter and only up 3% for the year. Other thing this tells us is controllable operating costs. As these have grown significantly, it is hard to operate in an environment where maintenance costs go up 50% in a 2-year period. That takes a lot of active management to make sure you're on top of it. You make sure you know how you're doing your repairs, what time and energy is going into them, what's being sent out to vendors versus what are you doing in-house. Those things are really going to start to catch up because if you don't have 25+% rental rate gains, you can't cover growth like that on the expense side. Another thing we're seeing, and we've kind of constantly been talking about this, is property taxes. These are typically there to stay. It's hard for property taxes to go back down once they go up. Now, that has happened. I mean, during the Great Recession, there were definitely instances where property taxes were decreasing and tax receipts for county were decreasing. But right now, that doesn't seem like that's happening anytime soon. So we're going to have high property taxes for a couple years to come. Another part that we're seeing or we're thinking about with these numbers is as interest rates are increasing, if that and costs are going up and revenue is going up, I mean, that translates to a more expensive living environment for any resident that's out there. And at some point, they're going to hit a demand curve where they're not going to want to pay that much more. Most of the stuff we operate is in the affordable end of the spectrum, and a lot of stuff that's even more expensive, I'm probably going to start seeing people be a little more hesitant to spend those dollars. So last one that we're really seeing is renovation opportunities. With such large revenue gains, that means there's inevitably opportunities to take older style or more classic units and renovate those and bring them up to market rents. Now, that was a very popular acquisition strategy 5, 6, 7 years ago, where you're doing these big value add deals. Right now, we're seeing that we can do a lot of this value add work on a unit turnover basis. Now, it's going to take us longer to do the unit turnover, and we're going to spend, right now, we're spending around $15,000 on big, heavy unit turns where we can redo kitchens, windows, bathrooms, redo all of that, and we're starting to see 20, 30% rental rate gains on those units. Now, we're doing a full reno on that. It's much better condition to get those rents, but we are spending that money out of cash flow that is earned versus doing, kind of a whole new deal pitch to make that happen. We're just doing it out of recurring cash flow. And that has worked pretty well. We have quite a few units where we're doing that, and our payback period on that investment is right around 3 years. And by payback period, I mean if we're going to spend $15,000 and we get $400 rental rate increase on that, that's $4,800 a year. That's roughly 3 years to earn back that investment. We look at things from an overall investment standpoint. If we can get a payback period of 3 years, we think that's a good deal, and we'll proceed with those investments. So, now, from investment performance in the fourth quarter, almost 3/4 of our residential assets paid out their distributions this quarter. All of our mobile homes sent out proceeds, and over half of our apartments sent out proceeds. The ones that held back on distributions were ones where we were reinvesting cash flow into those unit turns. We have that on 2 assets where we're heavily reinvesting into our units to increase those rental rates. Now, from a distribution standpoint, if you log into our investment management portal, when you're looking at it, if you go to documents, it has all of the details for each specific investment and what the annual report was on that and your end of quarter. On the activity side in the dashboard, it'll show you all of your distributions. So if you want a quick snapshot of Either what distributions did I get? That's in the activity section. If you want to read all of the reports and really dig into the financials of each property, that's in the documents section. From a trend standpoint of what we're looking at going forwards, any of our deals that are unable to meet our cash flow thresholds, we're in a market right now where if you can't make cash distributions, we're going to struggle to hold that asset. So we're looking at exiting deals that are not meeting their preferred distributions in the near term. Now that might happen for two reasons. One, the expense load might just be out of whack compared to how we're operating it, and it's not a good deal for us. And the other part could be if there are heavy capital improvements that don't necessarily need to be made right now, but we foresee future maintenance costs and upkeep and challenges associated with how our maintenance team performs. Those are two situations where we would look to exit the deal and roll that into a better performing asset for us. Next, I want to touch base on a little bit of the trends that we are seeing. Now, I mentioned most of our deals made distributions, but for deals that did not make distributions, we feel like in this environment, if we have mature operating deals that are unable to make distributions, that it is probably time to exit those properties, and we are going to look to sell those assets in 2023 here. Now, we just did a couple sales at the end of the fourth quarter. We closed one technically in the first quarter of 2023 here. We're still seeing very strong values and sale proceeds on all of those deals. We more than doubled our money. So we are still feeling like it's a good time that we can exit some of these positions and move them out of our portfolio. So anything that is not meeting its prefs, that's what we're going to look at. Now, some of these we're not paying out distributions because we are reinvesting that cash flow into unit turns. Those are not ones we're looking to sell because we're actually reinvesting. We feel like we can get good rental gains. It's the ones where we're not actually reinvesting and it's a mature asset and it's not able to meet its preferred distributions. Those are the assets that we're going to look to sell in 2023. We still see a lot of strong demand and pricing in 2023. It was probably more of the peak at the middle of 2022, maybe a little bit, third quarter 2022. But as rates have increased, it's certainly dropped off a little bit on the pricing volume, but we're still seeing very good rates, and we're going to look to take advantage of that and sell some of the assets that are not working for us and move those out of the portfolio. Thanks for watching. Please let us know if you have any questions. For more tips on operating and investing in real estate, please check us out at greenleafmanagement.com or find us on YouTube and Spotify.